My name's Dave DeBow, founder of MoneyPartnerFormula.com, and this show is built for everyday real estate investors who are actively doing deals and looking to scale using other people's money. So if you're an active real estate investor and you want to get featured on this show to talk about your own real estate and capital raising experiences, then just go to daveinterviewyou.com. Now let's get rolling with this episode, and remember to subscribe for daily interview content. Hey folks, welcome back. And chances are, if you've been in real estate for a while, and you've been especially in multifamily, you've been raising capital, you've been involved in investor relations. Well, that's pretty easy when things are all going well, but not so easy when things aren't going so well. And communication is definitely the key. And our guest today is Andrew Cushman. And Andrew is a very accomplished and experienced real estate investor, especially in multifamily. He's an operator, he's a syndicator, and his key to success long-term is open communication with his investors. So Andrew, welcome to the show. Great to have you.
Yeah, good to be here, Dave. Appreciate it.
So Andrew, give us a little snapshot as of, getting close to September 2025 at the time that we're recording this. What does Vantage Point look like? What do you guys invest in? What does the portfolio look like? What's your buy box, the market areas? Just kind of give us that snapshot, if you would.
Yeah, we've specialized in workforce multifamily since 2011 in the Southeast U.S. So right now our existing portfolio is in Georgia and North Florida. By the time this comes out, that'll have been about 3,200 units total, and we have sold off quite some of those as we've gone along. So about 1,700 units under management, and we typically, if we're owning something or buying something, it's between 80 and 300 units.
Okay.
Usually built between 1990 and today. We shy away from 60s and 70s, and it's targeting kind of the upper. Everyone says workforce housing. That's basic. We're targeting the people who can buy a house, but it might be a stretch, or they just kind of don't want to. They want to have a little bit of extra breathing room, and they just choose to rent a nicer apartment, but not a luxury apartment. So.
Okay. So how many different communities do you own right now?
I believe right now we own 12 or 13 separate communities. Yeah.
Yeah. All right. Very cool. So you're talking about your ideal tenant avatar. Give me an example. Like, who would one of these people be? Like, what do they do for a profession? Married couple, kids, singles? What does it kind of look like?
It depends on the asset. If it's like primarily one bedrooms, we have one asset that's all three bedrooms. The typical asset is a mix of one, twos, and threes. Usually our residents are, teachers, nurses, like we have some properties have a lot of like professors from the local colleges.
Interesting.
Maybe the manager of the local Walmart or the manager of the local restaurant, probably not the cashier, but the manager.
Mm-hmm.
And a lot of them are married, and therefore that's how they're qualifying to, pay the rent. And we try to make it so that our rent fits within the definition of affordable, which means that someone can take their gross income and spend ideally 30% or less of their gross income on rent. And so when we're evaluating where our rents, where we want to try to get our rents to, ideally they're at that 30% or below of the median income for the area. So that's who we're targeting. Yeah.
Yeah, that makes sense. So yeah, good, solid middle class type folks, right? That's really what you're focusing on. Okay, very, very cool. So when you're buying these kind of properties, you're doing syndications, what's kind of your model and your exit strategy for these properties? What are you looking to do with them?
Generally, we are looking to do light to moderate value add, and value add doesn't always mean go in with a hammer and a saw. That's typically part of it, but value add can also just be management play. And that's actually our favorite because it's the lowest risk. Well, it's okay. Well, what does that mean? As an example, we purchased a property last April where long-term owner, he takes care of his properties, but he doesn't upgrade them or really do any, he keeps them from falling apart, but he doesn't improve anything. And so when we bought it, his rents were $400 to $600 below the nearby properties, the comps. And so we bought the property. We're doing just kind of light upgrades to it. And, whenever.
So what does a light upgrade mean to you?
kitchen backsplash, adding ceiling fans, upgrading the flooring, upgrading the fixtures. So instead of a mixed match of bronze and in the old brass ones and and rusty hinges, to make them all like not it's not actually silver, polished bronze. I forget what it is off the top of my head now, but it kind of looks like it's silver, right?
Right.
And kind of upgrading the kitchens a little bit, putting in nicer lighting, and then beautifying the outside. So we're not like moving walls or taking it down to the studs.
Are you doing new appliances or not so much with the appliances? Depends.
Some properties, yes, some properties, no. Depend. I would say more often than I'd say 60% of the time, yes, it's new appliances. We will often go with black. We find the stainless steel, which was super popular, can be a nightmare to maintain because they show
Yeah.
every smudge and every scratch.
I got that in my own house. It's a pain in the butt.
Yep.
Okay, so when you're taking over a property and you're doing the value add, is it kind of onesie, twosie units at a time as people are moving out? Or do you go through and upgrade everything? And if so, how do you bump up the rent for existing tenants?
A little bit of both, and again, it depends on the market. And also, we'll be a little more aggressive if we're starting in March versus if we're starting in November, right? Because the
Hmm.
winter is a 10 tends to be weaker for leasing. So our kind of in the middle normal process is if we're buying a property with, to make the numbers easy, 120 units, and every month 10 units the leases renew. On average, half of them aren't going to renew, and the other half will.
Mm.
And we can only renovate so many units a month. So the ideal is the half that moves out, we upgrade those units and we at least put them out on the market for the full increase. For the
Right.
people who would like to stay, especially the first time around, we usually like to give them an option. And especially if it's like a $50 rent increase, probably not. But if we're talking like I mentioned a minute ago, 400, a lot of people can't adjust to that, and we understand
Yeah.
that. So what we'll do is we'll say, all right, here's your options. You can move to a unit that's already been renovated. We can renovate your unit, in place with you in there. We might not do flooring and things, but we can do most of it, and your rent's going to go to market. However, if they say, hey, I can't pay this or whatever, we say, all right, we understand. And typically, what we'll do is we'll allow them to do a shorter term lease at a much smaller increase. So if rents are going up 400, we might say, all right, we'll put you on a 6 month lease with only a 150 increase. That gives you 6 months to see if you can find a living arrangement that works for you without feeling like you're just getting kicked out. So we
Okay.
try to work with you because I mean on the investor side, it's really easy just to do this as dollars and cents. But
Yeah.
maybe if you're doing industrial or self-storage, but these are people's homes and their lives,
Yeah.
so we
Yeah.
try not to be too disruptive. And then if it's a larger property and there's maybe 20 units a month coming up, that's when we'll just say, hey, we can't do 20 units a month anyways. We can only do 10. So people who want to stay and not get a renovated unit, okay, you get a 12-month lease at maybe half the increase or something like that. So we tailor it to the property, to the income levels, and to the time of year.
Smart. Now that makes a lot of sense, Andrew. So we started the whole conversation talking about investor communication. A lot of syndicators, a lot of operators the last couple of years have gone through some pretty choppy waters.
Hmm.
That's pretty much affected everybody. I think you mentioned that communication is really, really important to you guys. A lot of people give that lip service, but don't actually do it. So what do you guys do differently around investor communication than what you see a lot of other operators doing?
Yeah, I think the number one sign that your investment is in trouble is when the communication stops.
Mm.
So, a couple of things. One, our investor updates tend to be very different than the standard. We don't just say, "Here's the financials. Good luck reading them." We include that, but then we actually provide a narrative. So there's a bullet point, like here's the summary at the top. Then we have a section we talk about occupancy. Then we have a section where we talk about revenue and then expenses and NOI. Then we talk about any renovations or projects. We talk about, have any changes in the team. Did we have to hire someone, fire somebody? And it kind of in each of those sections has a process where we said, well, here's what happened. here's where we are, and here's what we think is going to happen for the next quarter or two. So we try to give investors not only a snapshot of where we are, but where we think everything is headed. And then every report also includes some pictures of something that we did or that happened. And it might just be pictures from the picnic. Like we have properties that we've owned for 9 years.
Mhm.
It's, we're not going to take it. The investors have seen every building and picture, but so for those, maybe we'll include pictures of a new event, or if we put on a new roof, or something like that.
Right.
So we want to give everybody or your investors the data, but also provide the context for the data.
Yeah, that
Not
makes a
just
lot of sense
barf
because
300
it,
pages of financials at them.
yeah, that's just so gross for the average person to try and wade through, and they don't, right? So you're synthesizing it for them. You are giving the analyticals all the stuff that they want, and they can nerd out on all the numbers and the data if they want to. The other 90% of the population, which doesn't like that at all, they can get the big picture overview and get the gist of the whole thing by kind of reading the bullet points.
Yeah, and yes, and then the other big piece is consistent. Oh, there's three. The second big piece is consistency. So if you're invested in someone who's invested in one of our deals knows that the quarter ends, and then on the 26th of the following month, the investor report will go out. If it's a holiday or Sunday, it'll be either the day before or the day after. And in what, 15 years, 3,200 units, we have not missed a single one of those. Every single one, which is hundreds at this point, has come out on the 26th, give or take a day, of the month after that quarter. No matter what's going on, good news, bad news. And then that gets to the third part is hopefully you've got mostly good news to report. But if you even think there might be difficult news coming, you
Mhm.
start talking about it before it even happens. Say, hey, everything's going okay right now, but we're seeing, this challenge and this challenge coming up. So far, everything's fine. Here's what we're doing to try to prevent it. Just wanted to kind of let everybody know, right? That's the short version.
Mm.
Because it's human nature that in the absence of information, people typically assume the worst. So
Right.
in most cases, whatever you're telling them is probably better than what they were thinking in the first place. So just go ahead and tell them and save everybody the hassle.
Hey there, if you're a capital raiser, a syndicator, or a fund manager, and you're looking for a steady flow of incoming accredited investor leads, then go ahead, grab a free copy of my new book, How to Get 20 Accredited Investor Meetings Every Month Without Cold Calling, Networking, or Chasing People. You can get that at 20accreditedinvestorsbook.com. Again, that's the number 20accreditedinvestorsbook.com. I love it. You're so right. It is human nature, isn't it? Like we're just going to make stuff up in our heads. So, what would be an example of something that you had to some not so great news that you had to break to people, and how did you do it following that methodology? What comes to mind?
Do we want to go big or do we want to go mundane?
I don't know. What would be like the more normal kind of thing?
Okay,
You've been
yeah.
doing this for a long time.
All right. And when I say big, we had a property that got destroyed by a hurricane. So,
Wow.
um,
Okay. Well, you couldn't foresee that coming,
no, no,
right?
no.
So maybe
But we
one
still
that you
had to
kind of,
tell everyone what happened.
yeah, of
Well,
course.
actually, I take that. Okay, I take that back. I think actually that is a good example because not that one in particular, which financially is now the best property we've ever owned because the insurance company rebuilt it for us.
Wow.
Um,
Yeah.
but we own a number of properties on the Gulf Coast, and so every year this time of year there's
Mhm.
hurricanes, going in, coming, going by, and all that. And so whenever one goes even remotely close to a property, we will email everyone and let them know, hey, everything's fine, because everybody's wondering.
They're thinking about it.
Yeah, they're
Yeah.
thinking about it. Or like, hey, it came close. We got, a couple branches hit the roof, whatever. No significant damage, etc. In terms of, trying to foreshadow, like I'll give you an example. Like if a property, we've got, out of our current portfolio, everyone is cash flow positive. Everyone is making distributions. We don't have anything that's in distress. We have a couple that the occupancy is right around 90%. And we prefer it to be in the mid to upper 90s. And so, like, if we have a property that's in that situation, and we're writing the report, we'll say, hey, we're at, 90% today. We're coming up on winter. We're trying to make sure we don't get, occupancy doesn't drop any lower. So, next quarter, we might temporarily offer some concessions or we might temporarily lower rents. Therefore, we might see a slight decrease in revenue next quarter. We expect it to rebound, in the spring.
Mm.
Something like that. That would be kind of your normal, mundane. Hey, let them know
Foreshadowing.
what's going. Yeah,
Yeah.
forecast. Or like, hey, our we had to fire our maintenance technician, and the maintenance supervisor got promoted, and so now we don't have any experienced people on hand for a short period of time. That's a challenge. That kind of thing happens all the time, right? With
Right.
people. So just kind of just giving everybody constant, not hiding everything. I think
Hmm.
any experienced investor knows if you're running 100-unit property, crap happens every day, right? And that's part of your job as the sponsor is to deal with it,
Right.
but let the
But
investors.
once every 3 months, it's a good idea to let people know what's been going on and communicate that way. So is that kind of the communication? That's the rhythm is quarterly?
Yeah, we do quarterly. Yep.
Yeah. Yeah. Okay. Very good. So as we're wrapping up the conversation here, Andrew, what are your big plans or goals for the next 12 to 18 months? Where do you see the company going from here?
We're pretty excited. As you mentioned, and as everyone knows, it's been a pretty rough few years for the last several years, as we've corrected from, I would say, the syndication bubble. And that is leading to, I believe, going to be a lot of good opportunity to acquire the right assets in the next 12 to 18 months.
At better
Um,
prices? Yeah.
yeah, at 20 to 30% below what the peak was. I feel like multifamily in most markets, in terms of pricing, is bumping along bottom. You might have a market that goes down a few percent more or whatever, but some markets pricing's actually already starting to go back up. So, again, could we have, if you go to pick a market, could it go down another 3% or 5%? Maybe. Is it going to go down another 20 or 30? Really hard to build a case for that. And so I
Yeah.
think the next 12 to 18 months are a really good window to acquire well-located quality assets, because once we get through that time period, and this is actually already starting, new supply is just falls off a cliff. And that is actually the biggest reason that pricing has come down and that occupancy has come down a little bit, is because there's so much new supply. It's almost impossible for developers to, financially speaking, build right now. And so
Yeah.
you go out the next few years, there's an extreme shortage coming. And the shortage means significant rent increases because demand will outstrip supply. And so we're trying to position for that next upcycle that looks very clear to be coming.
Nice. Andrew, if people want to connect with you and find out more about what you're up to, where should they go?
Best spot is our website. So if you Google Vantage Point Acquisitions, it'll come up, but it's V for Vantage, P like point, ACQ like acquisitions.com. There's a couple of different tabs on there to get connected. So,
Awesome. Andrew, thanks so much for being on the show. This has been great.
all right, good talking with you, Dave.
All right, everybody, take care, and we will see you on the next one. Hey there, I really hope you enjoyed that episode. And as always, if you want to listen to more daily interview content, make sure you subscribe. And if you're an active real estate investor and you're doing deals and you'd like to get featured on this show, then just head over to daveinterviewsyou.com.